Hello and welcome to my presentation at World Risk Day on what makes a great risk manager and how innovation projects influence risk management success. This presentation and much of the content was generated from a paper that myself and a colleague did in coordination with Active Risk a couple years ago about what makes a great risk manager and looking perhaps a layer deeper at some of the skills and characteristics that many of the modern risk managers need in order to be successful. And in the last year or so, my work specifically with my own organization and clients around innovation have prompted me to bring these two concepts together in a way that I believe will be helpful for future risk managers and for those who are in innovation projects today to understand how some of the subtleties of both risk, innovation, and leadership can come into play to help that project be a success. We'll cover three primary topics today. The first will be an overview of what I call the modern risk manager and their roles and responsibilities, some mistakes they make, and what really successful risk managers are. We'll step back and talk a little bit about the challenges of innovation and how they present both risks and opportunities to an organization in terms of how new ideas can actually come forward and become real products or services for companies or organizations. And some advice going forward. I like to try to put into my presentations a level of practical recommendation for risk managers, things that they can take away with, and we'll talk about everything from leadership to technology and how those can be useful tools for you going forward in your role as a risk manager. We'll start with the modern risk manager. Probably the first and most well-known role of a risk manager is what we call the process architect. They are the individual responsible for building the infrastructure to manage risk, responsible for documenting the risk management process, creating the criteria, the standards, the decision-making structures that are required for an organization to identify, evaluate, control risks that may come up. I think this is the most well-known of all the roles, and I think in many ways the price of entry relative to being a strong risk manager. There's a lot of strong documentation around this role and obviously various ways to perform it. We'll talk a little bit about how this role can be impacted as innovation projects get underway. Another role for the risk manager that's not as well documented, at least formally, is this idea of your role as an integrator. This is a responsibility that is sort of building a bridge across the organization as well as with key stakeholders outside of it to start to communicate and discuss and identify risks that may be present in your organization. There are many, I think, benefits to why this role is important. One is the integration of best practices in terms of process ideas, also the integration of standards and compliance documentation that are required in order to get your organization moving forward. But there's also this other subtle, more influential role, which is about getting other members of the organization, particularly in middle tiers of management, to start to understand the risk process. They start to participate with it. They start to engage with it. You can build the best risk process in the world, but if no one's participating, then it really is not very helpful. And so this role of integrator, I think, provides a risk manager with what I like to call the ultimate backstage pass, which is this opportunity to get involved in many different aspects of a project or an organization. One of the aspects of being a risk manager that I find particularly interesting, but I think one that we too often take for granted and don't necessarily embrace as risk managers within projects. Another role can best be described, I think, in this evangelist and educator dimension. It's this idea that you are perpetually campaigning for and communicating the value of risk. In the slide before, I said it's important to have influence, and that is definitely true, but at the end of the day, you've got to transfer knowledge. You've got to not only teach people about risk as a inherently forward-looking discipline. There are aspects of it that may be difficult for people to engage with. Everyone views risk in a different way. At the same time, you have a responsibility to bring the next generation of risk managers along. No risk manager is an island, and there's, generally speaking, a team of people around you that are responsible for everything from collecting data to building reports. And those individuals need to be mentored and trained in a way that starts to give them an appreciation for the breadth of their role and how influential they can be within a business. There is a theory of mine that the best risk management processes are decentralized, and if you have created a situation where you are the sole proprietor of that risk process, I think you'll find it difficult to be successful in the long run. And so this role as an evangelist, I think, is well termed, because it really does mean you've got to be the one, at least in the beginning, creating a sense of momentum behind the risk process and carrying that forward, and not letting the natural obstacles that will come up persuade you from moving forward. This last role is what I really call the honest broker. As a risk manager, I think you have a responsibility to take into account this idea that you are there to be an individual perspective that in many ways can run against the organization. I don't mean that in a deconstructive way. What I mean is resisting this power of groupthink, remaining independent, looking at everything from both sides. And this is particularly true with senior leadership. Any organization, of course, has political realities and organizational realities that need to be taken into account, and we'll talk about that here in a moment. But I think one of the chief roles of a risk manager is having this integrity-based view of the organization that makes it not about the process, it makes it not about them, but it makes it about the empirical assessment of risk and how they can best communicate that. You'll see this gets important later when we talk about innovation and the way that organizational values can sort of bias the way that a new project may be considered successful or not. With those four characteristics, and certainly there are others, but I've put those together because I believe they cover a fairly broad spectrum of roles and responsibilities. I want to talk about some mistakes that a lot of risk managers make, and many of these mistakes are not made because of incompetence. They're not made because of political agendas. They're made because they've either set up a system or a process that doesn't quite suit an organization. They haven't been trained to tackle some of these problems, or they don't appreciate the subtleties of some of these leadership-oriented behaviors that we've talked about. The first one is what I call this "I'm just the process owner" excuse. This idea that as a risk manager, your responsibility is simply to architect the process. We talked about that role a few moments ago. But that you don't have a responsibility to understand whether it's the technology, the service, the customers, the stakeholders that are actually driving the risks themselves. One of the most insightful comments I got from a client of mine, he said, "I don't pay you to build the process, I pay you to manage risk." And this idea that I am conversant in the risks that our organization is dealing with, that I can get in front of a room and speak to 20 items, and then I don't have to always call on the risk owner, which is a common term for us, to come in and address the most basic questions. Sure, if you're in a high technology organization, you need an engineering expert to come in and speak to a particular item. That's perfectly acceptable. But I think all of us as risk managers have an opportunity to demonstrate leadership and to demonstrate a deeper layer of analytical insight by not falling into this trap. And I think it's something that gets important later on, particularly when we're talking about educating future risk managers. Another mistake is sort of putting it in more colloquial terms, is putting the cart before the horse. It is definitely in vogue and popular today to bring very sophisticated analytical techniques to a risk project, and I am a firm supporter of those, and we'll actually talk about some of our own techniques that we do later on. But I believe that too often we make the mistake of too quickly moving to those sorts of techniques before we've established the basic infrastructure. Not just process, but before we've established educating the organization, before we've established educating people on how the decision process works, before we've understood what data we have available to start driving those analytical techniques, and so that we're not just doing the garbage in, garbage out kind of system. And we all like flashy charts. We all like Monte Carlo simulation outputs and probability distributions and those things, and certainly, again, those are important. But I believe that oftentimes we become too enamored with that too early, and we fail to see some of the more foundational things within a risk environment that are required. And again, it's not just the process, but it's the layer of acceptance in the organization from many different stakeholders that I think is required before those analytical techniques can be appreciated. I think when you do that, you end up setting yourself up for failure, because you'll have people struggling to interpret this analysis without having an appreciation of where it came from. A few moments ago, we talked about the role of a risk manager as being responsible for educating the next generation of risk managers, and I think this is the corollary mistake to that role, which is if you view yourself as an army of one, this individual who is solely responsible for the risk process, and you protect that role without distributing the responsibility, I think you really endanger the long-term success of the risk management effort. Not only do I think you need to recruit and identify champions internal to your organization, whether it's senior leadership, middle management, junior analysts, people in the business office, you name it, those are all important people. I think we also have a responsibility to bring up the next generation of risk managers. We're trained in our business to work yourself out of a job, that my role is to set up the process, get the organization moving, get them educated, get them participating, get the system moving forward, and then turn the responsibility for the care and feeding of that over to a new risk manager that can then take on more senior level roles. I think that's a view that we need to have, and I think too often we end up protecting that role ultimately to our detriment. This last mistake is what I call the yes man mistake, and if you recall a few moments ago our discussion about your role as an honest broker, again, this is the corollary to that. You have to be willing to air the organization's dirty laundry. You have to be willing to say unpopular opinions, and recognizing that there are very subtle and important ways to do that. I'm certainly not suggesting one should be a bull in a china shop, but a lot of times there are individual and organizational biases that will help drive the risk process in a certain direction. Many of you as risk managers have been in the situation, as have I, where someone wants to make a risk yellow because they don't want it to look red in front of the boss. This happens a lot. It's a very normal thing that I believe, with all good intention, are designed to try and communicate a strong story. And certainly there are ways to communicate that story without throwing the senior leader or the project under the bus. And we'll talk about that a little bit later. But this is an important role that I think we, again, have to take very delicately and balance with a lot of professional savvy. And we'll talk about how that manifests itself later. So with some of these roles and common mistakes in the background, what do we know about successful risk managers? First of all, we know that they're flexible, and we know that they have the ability to build complicated processes that have multi-steps, various decision points for large organizations that require very structured decision-making. They have the ability to build more streamlined processes that are simple for smaller projects that don't require the same level of distributed decision-making. But ultimately, they understand that there's not a one-size-fits-all solution to building the risk process. And if we think back to that first role, if the price of entry of being a risk manager is that you have to build a process, then you better be flexible in how you apply that, because organizations, and particularly senior leaders and many clients of mine, they want to know that they're unique in some ways. They want best practices, but they also want those best practices tailored to their organization to create efficient and effective decision-making processes. So having that layer of flexibility is a crucial aspect for your role as a risk manager. Next, I think risk managers are savvy and influential. Again, if you think back to the role as an evangelist and an educator, You don't just mentor people, but you understand that there are alliances in the organization that are important, and that you understand that those are not just based on the individual, but you understand how the organization works. Every organization has three types of people. They have people who believe in the risk management process, they have people who do not believe in the risk management process, and then everyone in the middle. And the analogy I often use is much like collecting votes on Capitol Hill. Your job is to understand how to build alliances with those people, how to educate them, how to get them excited about risk, and how to move as many people as you can into the bucket of people that believe in risk. And you also recognize that there are organizational dynamics that may be counterproductive when it comes to building those relationships. That layer of perceptive influence is something that I think we often glaze over as risk managers, but is something that is very important in your role in being successful over the long term. I think, as we all know, risk managers, successful risk managers, are communicators. They have the ability to drill down at very detailed levels in risk analysis discussions or technology-based discussions, but they can also bring that discussion up many levels for senior leadership. We all know that the data and the reports that the risk manager consumes are not the same layer of data and analysis that senior executives consume. And so this idea that you have the ability to move quickly and with some faculty between those two dimensions is important. Again, when you put this in the context of your role as an evangelist, having the ability to talk and communicate at the level that people understand and speak in their language is an important way to build those relationships and be influential. And so I think this is something that many risk managers who have defaulted to the highly analytical role where they believe that their job is simply cranking out these more sophisticated techniques, they lose something here if they don't embrace this role as a communicator. And finally, above all, and I think most importantly, successful risk managers are persistent. There have been many books written about this topic, and I think the best way I can describe it, which is this short definition below, which is actually the definition for self-esteem. It's the ability to overcome resistance and to not let failure reduce your ability to move forward. Some call it persistence, some call it perseverance. But if you think about your role, for example, in this mistake as a yes man, it takes a tremendous amount of courage and willingness to fail to be able to be the one voice in the crowd that is not necessarily heading down the groupthink route. And this characteristic of persistence and perseverance is something that I think all risk managers need. This is definitely not a job for everyone. I've seen a lot of good young risk managers opt out of the career because they simply don't like that feature of the profession. And in many ways, I wish I had a better answer for them that feature wasn't there, but it is. And so I think identifying early on and recognizing that obstacles are natural and they are overcomable is an important role and perspective for risk managers to have. So I want to talk now about the challenges of innovation and how innovation can work with and against some of the things that we've just talked about. My own work on this topic has been influenced very heavily by Clayton Christensen, who's a well-known author and professor at Harvard, who's written a book called The Innovator's Dilemma, which I would encourage you all to read, and it's been produced many times. But I think it presents some unique perspectives that I've incorporated here, and in my role as a risk manager has been very influential. So first, we'll talk about these things called organizational and project processes. All organizations and projects have processes that are designed to drive a routinized, structured decision-making process into the business. They are designed to occur with frequency. It could be everything from financial reporting to technology reviews to marketing meetings. They are done with a layer of routinization that is important and it's necessary. Innovation, however, is by definition a non-routine activity. They are things that in many ways work against the natural processes that an organization may put in place. Secondarily, processes are meant to filter large volumes of data very quickly. to give senior leaders the ability to make many rapid decisions with this idea that I can determine things like return on investment very easily. Innovation can't always be quantified, and if you think back to this idea about risk and these more analytical techniques, risk suffers from some of the same challenges. This ability to quantify the unknown is often something we get asked to do quite regularly. And so I think from this standpoint, putting these organizational and project processes in the context of risk can have several implications for risk managers. The first is that as the process architect, you spent a lot of time building this process for the organization, and now we've got a project or an innovation activity that runs somewhat perpendicular to that. Maybe you don't use the same scales. Maybe you have a different decision-making timeline. And as a risk manager, you've got to figure out how to operate within that space. You certainly don't want to go off and spend the time to recreate a whole separate risk process, but at the same time, if you do it in a completely unstructured way, you'll find it difficult to fulfill some of those roles as evangelist and educator and honest broker, because people won't be operating from the same standpoint. And then this idea as an integrator that your job is to build bridges to other functional organizations within the project or within the organization, functional groups, excuse me. This is going to make it difficult to bring in things like cost, things like schedule, the traditional outputs of a risk-based assessment. If those groups aren't able to quantify and evaluate the true nature of the innovation impact, how long is the project going to take, what do we know about the customer base, can we quantify our return on investment, those things will be very challenging. The downside to that is you may spend a lot of time dealing in sort of esoterics and academic discourse, which can be challenging for a risk manager. We spend enough time there as it is. And so these are things that I think we'll talk about some solutions for a little bit later in terms of how you can still be successful, recognizing that there are some limitations to the organization and how they deal with innovation. I made reference earlier to these things called organizational values, and again, I draw heavily here from some of my own research and some of the work of Clayton Christensen. Many organizations and projects have formal and informal values. We all experience them every day. Some define them as organizational culture, but they are the priorities and decision criteria that an organization makes that determines what business they'll be in, what customers they will serve, how they'll fulfill their mission if you're on the government side. And as risk managers, we take those organizational values and we build risk scales off of those. We define what's a red risk, what's a green, what's in between. And we use those, and they're important inputs into structuring a risk process. They're absolutely essential. We've also got to recognize that those things can also create boundaries to decision making. They can create artificial limits about what projects may move forward if they're not inside the bounds of that traditional decision-making structure. If, for example, you have an innovation project that is consistently showing up red because it's got a potential cost impact or a high investment, maybe it's a new software tool, maybe it's a new piece of hardware technology, maybe it's a new service, if you can't demonstrate an ROI that scratches the itch of that decision-making, that historical decision-making structure, that project may not move forward. And that's unfortunate because, again, it's not necessarily reflecting the inherent risk. Projects that don't fit the company brand or service, again, there are many companies that identify themselves within a certain line of service or technology or image, and innovation projects can often run counter to that. And that doesn't mean that jettisoning the project is a bad idea, but it's just bringing a layer of awareness to a risk manager that in your role of communicating what the inherent and empirical risk is, you're working against a structure sometimes that most organizations don't even recognize is working against them. And also, if we don't satisfy core customers, this idea of moving in a different direction, satisfying a lower margin segment of the customer base is something that particularly large companies don't do well. And so there are these aspects of innovation that I believe can present some real challenges from a risk point of view. So what does that mean in your role as a risk manager? Again, this idea of your role as an honest broker and not being a yes man and really describing the empirical risk of a particular project, to recognize that there are going to be organizational biases that will make some of these decisions harder than you expect. And so that is where this role and your ability to communicate comes in even more meaningfully than may have in a traditional risk process, where you've got to raise the awareness and get people to sort of unlearn what they've learned from the basic risk process and start thinking about innovation in a new way and connecting those two together. We also talked about, from a process point of view, in your role as a process architect, again, you've spent time tailoring. Maybe it's you've got a 5-point scale from high to low. Maybe you've got a 4-point scale that's got some very specific cost and schedule buckets associated with that, performance impact. Maybe you've got a scale that's built around brand identity. And this innovation project may not fit comfortably in each of those dimensions, or if it fits, it may rate consistently very high. And so you've got a question in your head to solve, which is, do you recast those criteria in a way that fairly represents the true nature of the innovation risk, or do you keep those scales and try to work against the organizational biases that we've just talked about to get the risk more generally understood? Again, not an easy thing to solve, and it's all highly dependent on the situation, but it's this relationship between organizational structure and process that I think is important for us to keep in mind. The next tier, I think, that challenge that innovation projects present in terms of challenges is this layer of middle management. Middle managers in organizations are absolutely critical to keeping an organization moving forward. They generally have financial responsibility. They generally have responsibility for moderate to smaller teams that are essential for interacting with customers or clients. And so those groups, if you think back to our role as evangelist and educator, those people are absolutely essential to be champions of the risk process. The challenge you're going to run into is that not just managers, but people tend to define and perceive risk according to what they've learned in an organization, as well as with our perceived sense of control. It's the one reason why people feel safer driving than flying, even though you've got a 10,000% chance, less percent chance of ever being in a plane crash. And so understanding that dynamic, both at an organizational level and at an individual level, is important. Managers tend to define risk as things that they don't understand as more risky than those that they do, and there's a lot of good evidence to show that. I've cited some work here that is very popular among risk managers. And so they may perceive the creation of new markets and new products as riskier than they'd like to take on. Maybe you need one of those middle managers to be your project champion, and they're not willing to take on that role because the potential of failure for them is either career threatening or they don't understand the technology. And again, it's not because they're doing anything with an eye towards not making the organization successful. They're just responding to their own biases. And so what happens is that many of those managers regard sort of non-innovation projects as less risky. Maybe they're incremental improvements to a service we already have, a small pocket of a new customer base that's very close to the one we already have, because they understand how to operate within that space. So if we think about that from our role as risk managers and what that means, I think it directly challenges this role of an evangelist and an educator. Individual biases are natural, and they're going to happen, and you've got to use that perseverance characteristic to plow through some of these challenges and recognize that if you've got a population of 10 middle managers that you need to participate in the risk process, you might get 7 of them, and that's okay. But it's absolutely essential that you recognize the bias and the perspective that those individuals are bringing to the table, particularly as it relates to innovation projects, and you think about what we just talked about on the ability for them to perceive risk as inherently more or less risky. I think there's another impact in your role as an integrator in building bridges to other organizations across the project, because again, those organizations are run by managers at sort of the middle to kind of upper tier level, and we just talked about the challenges that they may have, that all individuals have, in dealing and conceptualizing risk and taking what they've learned and applying it in a new way. And so with innovation projects, this role as evangelist and educator and integrator is even more important than in a traditional project where the parameters and the outcomes are known, because you're going to be constantly dealing with educating people on being comfortable in this space of uncertainty. So we've talked about many things here, and I want to put this into practical terms moving forward a little bit and sort of put a bow around many of the concepts we talked about, and move forward and help the risk manager kind of cope with some of these challenges. I think the first one here is flexibility is even more important in innovation projects. You've got to be willing to modify the risk process. Don't be rigid in terms of being a purist, as I call it. Many risk managers, I think, can be overly dogmatic about recognizing that it has to be a 5-step process and the outputs have to look like the traditional red, yellow, green. One way to do that is to frame things in terms of opportunities. Opportunities are obviously a new and trending concept in the risk world, and there are people who believe opportunities exist and believe that they don't. I'll set that aside for a moment. But simply getting an organization to view an innovation project as a new way of operating, a new service, a new product, a new way of challenging not just internally in the business how we operate, but challenging our customer base to feel differently about the things that we do. And so this idea of framing the innovation project as an opportunity instead of risk is one technique you can use to get people out of this fear of loss of control and sort of sense of the unknown and start talking about the upside of the innovation project instead of exclusively focusing on the downside. It's important to do this one-on-one as you meet with individual risk owners or middle management or senior leadership. It's important to do it in risk boards when you're talking about evaluating risk. Every opportunity that you have to evangelize the opportunity of an innovation project, I think, is another opportunity that you have, sorry to use the word twice, another opportunity you have to recast this bias problem that we've talked about inside of an innovation project. I think the next thing to recognize here is that organizational values and what we've talked about, this decision-making structure, this cultural construct that exists with inside organization is important, and recognize that you're likely not going to change all of it. Too often I think we spend time sort of pushing the rock up the hill and trying to get the organization to recognize that they need to behave differently. And my recommendation is educate senior leaders about organizational values and how it impacts the perception of risk. But don't try to change the organization. Find ways to operate with it. Maybe you do need to change and create a secondary risk scale that is more attuned to an innovation project where the risk thresholds are a little bit higher. That's one way to think about recasting this risk process inside of an organization. But I think if you'll find as a risk manager you are focused exclusively on telling the organization they're wrong instead of finding new ways to tell the organization they're right, you're going to be unsuccessful in the long term. And this one I think has been said in many cases, and it's a solution that works not just here but in many places. This idea of communicating and over-communicating. Don't be afraid to tell it like it is. This is the role, sort of embracing your role as the yes man and not falling into that trap. Excuse me, your role as the honest broker and not falling into that trap. Your job as a risk manager is to help the organization deal with risk, not completely avoid it. And I think we get stuck in that trap of trying to find ways to cut risk out as opposed to finding ways to mitigate it. That's our job, is to manage risk. We're not risk avoiders, we're risk managers. And I think that concept gets lost for a lot of people. The other thing is important is actually managing the customer, and whether that's a government customer or a business customer, getting senior leadership to engage with them early and often is an important aspect of this whole thing. And finally is this idea of embracing failure. Actually, we've got one more topic, excuse me. This idea that not being afraid to accept some small pockets of failure and getting the organization to diversify the portfolio, whether it's an innovation project that is a critical new business, but don't put all your eggs in one basket, in the sense of have ways to offset the natural obstacles that will come in your way, whether it's organizational, whether it's slow to market, whether it's a technology problem. recognize that those will happen. You've got to both keep the organization from fighting through the natural desire to stop, but also keep them recognizing and seeing the upside back into this concept of opportunity. And finally, I think I'll do a 180 on myself a little bit and talk about these advanced analysis tools and techniques. They can and are very useful techniques to deal with some of this uncertainty when it comes to evaluating the true nature of the risk. We have our own solution here that we've built that we use and sell. It's called Polaris. It brings many cutting-edge, leading-edge technologies around more advanced analytical techniques. But don't be afraid. Recognize earlier, you want to have the infrastructure in place, but don't be afraid to use technology when you need it. Don't be afraid to try and quantify the amount of uncertainty that's out there to give managers a sense of what's possible and what isn't. These tools can be very helpful, whether it's a tornado chart, a distribution, a regression analysis, understanding the cost profile of a particular project. Those can be powerful tools. Don't overrepresent what they are, but recognize that they can be very influential, particularly when you're trying to quantify the upside, when you're trying to quantify the amount of opportunity that you have available in an innovation project. This concludes my presentation on how successful risk managers can be influential within an innovation project. I appreciate you taking the time to listen to the webinar today. Thank you very much.